Had them all long before I dialed up. How they came and they on top and I'm a mile up. Had them all long before I dialed up. How they came and they on top and I'm a mile up. I know the wall's closing in, but don't you dare give up now. Poe believed in me, pull up through some bucks down. Todd told the valet pull the truck round. Push the line after we drew it, it's just us now. Would you believe me if I told you my granny told me she prayed this? Then booked the surgery just to pull me out of the basement. Right back where I started, nothing to show for a facelift. Got pushed playing Walter White and Davis, never felt so dangerous. The type of power they can't quantify. And name the best from my region, you gotta utter mine. Think of who really putting on, you never come to mind. Rapping like your Spotify, tap you rappers compromise. Yeah, no need to panic, just paint the canvas. If you can feel the static, you're too close, find your balance. Embed the revolution for they prohibition bandwidth. Blood trickle from the leaders he was planning. I had them all line before I dialed up. How they came and they on top and I'm a mile up. I had them all line before I dialed up. How they came and they on top and I'm a mile up. Bought at that flight to Amsterdam. When my accountant of minus my family found out too and didn't like it. You're not in the salon with Dale said and I thought he was biased. Then I got a Venmo that said copy the finest. Before my foolishness settled in, recorded a whole tape before we got to Berlin. This close to giving up but now never again. Don't overlook the work and come expecting to win. In the end, my word, never put nothing over the squad. Got it right up under their nose, gentrify the facade. Off the cliff with broken wings, I'm aware of the odds. Enough faith for us all, I'm the one for the job. Most days, catching sun rays, baby, look like the front page. Overthinking what they might say, have it your way. Yeah, the biggest threat is something they never seen. Dial it up, patch me into the screen. I had them all line before I dial up. How they came and they on top and I'm a mile up. I had them all line before I dial up. How they came and they on top and I'm a mile up.
Greetings, everyone in Lukman Nation. Welcome to another episode of Lukman Nation, the most dangerous show on social media, on the most dangerous platform on social media, Black Power Media. I'm Jacquie Lukman. Welcome again to our Friday night show. And tonight is our third Friday economics or Blackonomics show. And I'm very happy to be joined again by Dr. Linwood Tauheed, professor of economics at the University of Minnesota at Kansas City. I got it right this time. Missouri.
No.
I don't know why I have Missouri in my head, but Minnesota comes out of my mouth.
Nobody wants to talk about Missouri. I understand. keep it out. Yeah. Stay away from
I'm so thankful. I'm thankful that you are the professor of economics at the University of Missouri at Kansas City, and that you take time out to be with us one Friday a month to talk about all things economics, or as we say, Blackonomically speaking, because all of this economic stuff really does matter to us.
Yeah.
So thanks so much for joining me again. Before we get started, thank you all for joining. If you have not subscribed to Black Power Media, subscribe right now. Hit the notification bell so you can receive notifications for when everybody goes live on this platform. Lots and lots and lots of content all the time. You can support Lukman Nation. Yes, you can support Lukman Nation on Patreon, patreon.com/Lukman Nation. You can support Black Power Media on Patreon as well. You can subscribe to Black Power Media on YouTube, and you can also, just drop us a little bit of change when you feel so inclined. We appreciate it. Brewski says hello, everyone. So let's get started. Dr. Tauheed, economists have been in a little bit of a tizzy of late because apparently the Federal Reserve, they think, is about to raise interest rates. I hesitate to say again because interest rates have been pretty low for the past few years, particularly because of the pandemic.
Mm-hmm.
And usually, what I see when we talk about this kind of thing are these kinds of articles where there's a lot of economic speak. There are a lot of things, a lot of phrases that people don't understand, a lot of terminology that people don't know, and it just completely turns them off from reading the details. Like this statement right here at the very beginning. The U.S. Federal Reserve will kick off its tightening cycle. What does that mean? In March, with a 25 basis point interest rate rise. But growing minorities say it will opt for a more aggressive half-point move to tamp down inflation. While inflation is rising across the globe, it is particularly hot in the United States, hitting a 40-year high last month. Okay, couple of things. What the devil is a tightening cycle in regard to the Federal Reserve and economics, and why should we be concerned about what that is?
Okay. The idea of the Fed, the Federal Reserve Bank, tightening or loosening has to do with the availability of money in the economy, particularly money that's going to be loaned from to borrowers from banks, right? And so when the Federal Reserve does what it does, and we'll talk about that, but when it does its what it can do to tighten money, to make money harder to get. That's a tightening cycle. When it does what it does to make money easier to get, that's a loosening. Raising the interest rate makes money harder to get because people are less wanting to borrow, businesses and private citizens as well. When the interest rate is lowered, then the interest rate it's easier to get money. And so a tightening cycle in this case is the Federal Reserve is looking to increase interest rates in order to make money harder to get. Now, you might ask the question of why it would want to do that. And the idea that the Federal Reserve wants to make money, at least in this instance, wants to make money harder to get, has to do with the inflation that we've seen over the last year or so, and that inflation rate, which on a yearly basis is about 7.5%, is the highest since in a while, 1950s. And inflation is something that the Federal Reserve wants to keep down. We were at inflation at 2 and 3% before the pandemic. That's considered fairly normal. But rising into 7.5% is causing lots of consternation. And therefore, people are calling on the Federal Reserve to increase interest rates in order to bring down inflation. All of last year, Jerome Powell, who is the chairman of the Federal Reserve, had it right with regard to inflation. He was saying that inflation is transitory, that it's here because of the economy is recovering and it will go away. Unfortunately, there are things that are outside of the purview of the Federal Reserve or even of the U.S. government that's causing that inflation to stick around a bit longer than it should, and that people will want. So the Federal Reserve is looking in March. It's already announced that it's going to raise interest rates in March. But the question is by how much, right?
Right.
And then they've also said there'll be a couple more this year. So
Oh,
probably
wow.
three or four. So maybe, one every quarter. It depends on the effect that each of those rate hikes is going to have. Okay.
So I'm glad you explained that. And we have a great question in the chat. And I don't want you to feel like a dummy, Leah, because this was actually the question I was going to ask. How do interest rates bring down inflation? Now that's one question,
Mhm.
but then I think the other part of this question or an observation is that when economists say that, the economy is recovering, they're not talking about, you, me, all the working poor, the working folks, the poor folks. Who are they talking about? When they say the economy is recovering, who are they
Mhm.
talking about?
Well, we have differing classes of people in the economy, different groups of persons in the economy. We have those who have more money than others, right? Two
Mm,
basic groups, right? And what we've seen in this recovery is really a tale of two cities, right? Those who there are persons who during the pandemic never lost their jobs. In
mhm,
fact, not only did they not lose their jobs, they're able to work from home. And so if you don't lose your job and you're able to work from home, your income continues as it was. And then, of course, the pandemic support sent extra money to everyone. They would get it also. Now, during the pandemic, they were not able to, during the depths or heights of the pandemic, when it was the worst, the economy was closed down. People weren't able to spend that money,
mhm.
particularly those who would use that money, let's say, for summer vacations or to go on cruises or other kinds of things. They couldn't go, and they shouldn't have
Right.
gone. And
Right.
so they saved that money. They saved that vacation money that they were building up, plus the extra money that they received from pandemic support. And when the economy then starts to loosen up, that money starts to get spent. Okay.
Mm,
Of course, there's another part of the economy, people who lost their jobs,
mhm,
for whom pandemic support just replaced income, sometimes with a higher replacement of the income than they were making, which means they were making too little. if
in
if
the
if,
first place,
if
right.
yeah, if $300 a week can replace is more than your income than you were making, at minimum wage, then
Hmm.
that doesn't say much for how much you were making. It's but they were able to have some income to provide food, clothing, and shelter. For many people, that still wasn't enough,
Hmm.
and they started to fall behind on rent and mortgages. And so when the foreclosure moratorium dropped, they're now subject to foreclosure and eviction and so forth. So we have a growing homeless population. So while the economy is doing well for some, it's not doing well for others. But it wasn't doing well for others before the pandemic. The pandemic just exacerbated that issue.
Right.
Now to that question about how
Hmm.
does interest rates affect inflation, let's first talk about what economists think about when they think about what's the cause of inflation. And everyone is taught at some point or another in their educational careers, even in elementary school, about quote supply and demand, right?
Hmm.
Supply is the goods and services that companies are able to produce and wanting to produce, and demand is what consumers want to spend in buying those goods and services. So a standard way of thinking, well, and it's not wrong, but it's a way of thinking about a cause of inflation, is that it says too much money chasing too few goods. And so people want more than the economy can produce, and that extra consumption or desire for consumption means that the products that are being produced are kind of the prices are bid up. They start to rise because business owners realize they can increase prices, and people they'll still be able to sell out all of the goods they're producing. So that's one way of thinking about inflation. That way of thinking is driving the ideas of those who are saying that the federal government putting money out into pandemic support put
Mhm.
too much money out into the economy, and now people are wanting to buy stuff, and there's too much money and too few goods. That way of thinking is let's label that conservative.
Yeah,
And
because
and,
I'm feeling like that doesn't make a lot of sense to me.
and by the way, most economists are conservative, so that's the theory that they use for the current inflation. The problem is that that's not what's happening. What's
Mm,
happening is not that people have too much money. The fact is there are too few goods. So we know, for example, there's a supply chain problem. There is a problem getting the usual goods and services from foreign countries, China mainly, and because of globalization, products that used to be made here, manufacturing goods, are being made somewhere else.
mhm.
Those goods are made there; they have to be shipped into the U.S. And when things are going well, that's kind of seamless, but the pandemic put a hiccup in that and exposed some problems. One of which, when the Chinese, who are a big supplier of many goods into the economy, they tackled COVID very
Mhm.
aggressively, and
Mhm.
they shut down their economy, which meant they shut down their production of goods that we buy, right?
Right.
And
Right.
so, and that was fine while our economy was shut down. People weren't out buying a lot of stuff; they were saving their money. But when the Chinese began to reopen their economy and they started to try to surge that demand, produce lots of products, then the weakness at the docks, at the ports, began to show up because many dock workers, for example, during the pandemic, had decided to retire, had been laid off because the ports were not operating. You have port workers, some of whom are union workers who are paid on a regular basis, but then you have lots and lots of, let's say, contract and private owned truck drivers who were not able to make a living because they weren't not able to pick up a number of loads that they needed to make a living. And so, since they weren't able to make a living, many of them were forced out of the business. Some retired, some just went bankrupt, and so when the surge happens, those drivers are not available,
Mm, mhm.
and so cargo ships begin to pile up at the ports, and we have this supply chain crisis, which means that people now who would be normally spending the spending that consumers want now is not an extraordinary amount of spending; it's regular spending,
Mhm.
but there's too few goods, and that's causing inflation. So that's an opposite of what the conservative way of thinking, that there's too much money, there's actually too few goods, right? This is a supply problem, not a demand problem.
And interestingly, I think this is really a corporate America problem.
Hmm.
A problem. This is the realization of what was wrong with the legislation like NAFTA in the first
Hmm.
place.
Hmm.
This is not, and I feel like politicians are using this as another excuse, just something else to pile on to the
Hmm.
anti-China rhetoric,
Hmm.
blaming China for, oh, now we have a shortage of goods. But it was the United States under our favorite president, the first Black president, Bill Clinton, who pushed
Yeah,
NAFTA. And
right.
and sadly, I think it was, yeah, I can't remember who actually said that, but
Yeah.
under NAFTA was the legislation that workers, I remember workers around the country protesting the
Hmm.
passage of this legislation because they knew that they would lose their jobs, that manufacturing would disappear in this country. And here we are. So this
Right.
is, I think that, looking at it as, of course, it is a supply chain problem in the micro sense, looking at it in a very, very narrow way. But
Mm-hmm.
I think that looking at it politically, it is a neoliberalism problem.
Yes. Yes. Yes.
This is what neoliberalism does,
Mm-hmm.
when we're talking about protecting good jobs for workers. So
Mm-hmm.
so here we are. So I hope that answered your question, Leah. It sure answered mine.
Well, I didn't actually get to the interest rate thing yet.
Oh, you do? Okay. So
You know,
yeah.
we were just talking about what causes inflation, right?
Oh, that's right. Okay.
And so, by the way, it was Toni Morrison who coined the Bill Clinton
Oh
was the
yeah.
first black president, the illustrious
Oh,
Toni Morrison, who what do we say about that?
I mean, can't be perfect. Nobody's perfect.
Exactly, exactly. But we have okay, so we have this inflation that is by the conservative standard way. There's too much money out there, right?
Mm,
And so the Federal Reserve Bank only has control over one interest rate. That's its own interest rate. That's called the federal funds rate. And the Federal Reserve Bank is a bank for banks.
a
And so
bank for banks.
when
Okay.
banks need to borrow money to make loans, they borrow that from the Federal Reserve, and the Federal Reserve charges them an interest rate. And that interest rate would be they can borrow from the Federal Reserve, but they can also borrow from other banks that have surplus of money. And the interest rate that banks use to borrow from themselves in the banking industry is the rate that the Federal Reserve sets. It sets that rate.
Okay.
Now that's a rate that's going to be the lowest interest rate in the country. You and I can't get that, but banks can get that. And so when banks, for example, borrow money and pay the federal funds rate, the interest rate for the Fed, which is, I believe, about half a percentage point, it's not very high. Um, then they take that rate and they say, how much profit do we want to make? And so if the rate is let's say 1%, and the bank wants to make 3% return on the loan that they make, then that would make their rate 4%. But then they also want to include the inflation rate in their borrowing, because what happens is if a bank or any lender loans money at one inflation rate, let's say there's zero inflation.
Mm-hmm.
So a bank, you borrow $1,000 from the bank today, you pay it back in a year. That $1,000 is worth $1,000 in a year because there's no inflation,
Okay. Mm-hmm.
right? And so the rate, how rates get set is you take the federal funds rate, the Fed rate, and then you add the amount of profit that the bank wants to make. So if
Wow.
the bank wants to make 3%, then and the Fed funds rate is 1%, that makes the lending rate 4% at zero
Oh.
inflation, right?
Mm-hmm.
But if there's 7.5%, or let's make it in round numbers, 8% inflation like there is now, the bank's going to add that 8% inflation to the
Oh.
4%, right? 1% plus 3% plus 8% is 12%. That's your lowest interest rate. If other interest rates for borrowers that are more risky will go up higher than that. So even for your least risky borrowers with a 7.5-8% inflation, the borrowing rate is going to be fairly high. And then for more risky borrowers, those who have low income or bad credit but can still borrow, the interest rate then goes up higher and higher. So, for example,
Mm-hmm.
interest rates on credit cards is in the 25%
Right.
range, right?
Right.
And so now what the Federal Reserve wants to do is increase the interest rate that banks will have to pay to borrow money from each other or from the Fed. That causes banks to raise their interest rate even more,
Mm-hmm.
which makes it more expensive for businesses to borrow or for people to borrow for mortgages. And so people will stop borrowing for mortgages and stop businesses will stop borrowing for expansion or for other kind of things. That slows the economy down, so that brings the demand for things down, and that
Oh.
brings inflation down. So if you think that there's too much demand, raising the interest rate brings that demand down. The problem now is it's not a demand problem, it's a supply problem. And so you're really going to punish people who are just doing their regular spending, and people who would want to buy a home and have the housing market is going to contract as a result of an interest rate increase, which means that people who build houses and workers who work in the building trades and all that, there'll be less housing built, and they're likely to lose their jobs. And so there's this trade-off that happens between the rate of interest and employment. If the interest rate is too high, the economy tends to slow down, which will slow down inflation, but will cause higher unemployment. And since
Wow.
1978, I believe, we had it's called the Humphrey Hawkins Free Full Employment Act. Hubert Humphrey and Gus Hawkins, who was an African American representative, I believe, from Georgia, had a bill that got passed that said the Federal Reserve should not only care about interest rates, about inflation, excuse me, but it
Mhm.
should also care about full employment. In other words, it shouldn't raise the interest rate to cause a recession.
Mhm. Right.
And many are saying that this interest rate hike that the Federal Reserve is going to do in March will slow down the economy too much. But as your story said, there are some who want to even go higher, the interest rate to go even higher, which will slow down the economy even more. But they're not caring about unemployment; they're caring about what banks have to do and be concerned with, which is inflation.
So, first of all, the idea that um, banks, we're taught that the money that we put in banks is where,
Yeah,
that we fund,
yeah.
loans. And so you mean to tell me, Dr. Tauheed, that the money that we put in banks is not what funds loans and interest? Banks
Mhm.
borrow money from the Federal Reserve. I have
Right.
banked with a particular bank for the past,
Yeah.
let's say I've banked with one bank for the past 30 years, and let's say I've got, $100,000 in there. I don't, by the way, not, I do not. Just an example. So if I want to go get a loan, I can't go in there and say, listen, I've been banking with you people for 20 years. You
Uh-huh.
can't give me a better interest rate than this. I've been loyal to you. And they pretty much can say, well, that's nice, but we don't have to give you a better interest rate because we
Well,
don't even use your money to make loans.
well, having banking relations for a long time with a bank puts you in a better situation than someone who doesn't, who just comes in and never did any business with the bank, because the bank has kind of a history of your deposits and knows that you haven't bounced checks and other kinds of things, so you're maybe credit worthy, or at least you have a good relationship. But you're right on point here. We think, because of the way the education system,
Mm,
because of the way that we're taught, is that you take your money to the bank, and your money is in a vault somewhere. And when people come to make loans, the bank goes into the vault and pulls out, $1,000,
right, right.
10,000, and that's the money that gets loaned out. That's not the way it works. And the way it works is that a bank, on its balance sheet, has what are called loanable funds. Now, those loanable funds are from the deposits of its depositors. So if a bank has $1 million in deposits, then right now 90% of that million becomes loanable funds. That's 900,000. And so the bank can initially make that amount of loans. But think about it this way: if the bank makes a loan to a customer, and that customer deposits that money back in the bank, now the bank has more money to loan just from making a loan.
Oh my
Making a
God.
loan makes more money, So it's not your initial the amount of money that a bank can lend is many times the amount of deposits that are in the from depositors, and it only needs to keep by law right now 10% of that money around, not in the vault because it's in the computer system, right? It's in your bank account. They don't have to keep the paper cat or the coins anywhere. But so the idea that a bank is going to run out of money if too many people come, well, it's in the computer system. They just debit your bank account and credit, wherever you want it to be. If you want cash, then that might be a problem because banks don't generally keep that much cash around.
Hmm.
There used to be a time when you had armored cars
Right.
that would be driving around, and
Hmm.
what happened, they stop at a bank and they pick up the cash that
Right.
was
Hmm.
deposited that day, and they take that money down to the Federal Reserve.
Mm.
And the Federal Reserve will, by computer, credit the account of that bank that it came from. And that bank may never need to see that the paper money,
Hmm.
ever again. But when a bank wants to make a loan, if it doesn't have enough money to by law make the loan, because a bank can always, if you want to borrow $1 million, a bank can always by computer put $1 million in your account. That's not a big deal. There are restrictions by law that says it has to have so much capital on its books,
Mm.
and if it doesn't, it has to borrow that,
Wow.
and it can borrow it from another bank that has extra. And if the Federal Reserve is what's called a lender of last resort, if there's no extra money in the banking system, they can borrow it from the Federal Reserve, and they borrow it at a very low interest rate. Then they add their interest and profit onto that and account for inflation, and that's the interest rate that they charge. So
Wow.
yeah, it's a myth that banks are loaning or lending your money. They're creating money on the fly.
Wow, Dr. Jared Ball in the chat said that the best way to rob a bank is to own a bank, and
Yeah,
that
absolutely.
really sounds like it's true. We have another
Yeah.
question on this topic, and then we're going to go to the next topic. Dollar Will, pun intended, asked, "Are credit unions different?" That's
Yeah.
a good question, I think.
Yeah, no, credit unions, at least as far as making loans, are no different than private or commercial banks. What makes a credit union different, of course, is that the members own the bank,
Ah,
and as opposed to, let's say, private interests putting money together to own a bank. But as far as the lending and the money creation process, credit unions are part of the system. They can borrow from the Federal Reserve as well.
wow,
Yeah, so they're no
interesting,
different in that way.
man.
I mean,
That's
money in general in the U.S., but in every country is only as good as the country.
well,
So
we know
you,
how that
you
works
know how
out
that
for
might you know
us.
how that might go, right? So far, the U.S. money system has, it's taken lumps over the years. It's recovered because people still believe that the government can back it, can bail things out. Because see, like banks have regulations on how much money they can create. The federal government doesn't have any limit on how much money it can create. It can create as much as it needs to do whatever it needs to do. But what limits it is for example, with the pandemic spending, and you had the Build Back Better bill, and you had Manchin and Cinema who have stopped the process.
Mhm.
Their objection is that there's already enough money out there. We don't need to create any more money. That's one objection. And what they're objecting to is the federal government spending money to create jobs.
Not,
And
not,
so,
not, not that they're not mad that the federal government just creates more money. They're like, look, if we want to fund another war, print it,
exactly,
do it.
exactly,
But feed
exactly.
people,
Yeah,
house
for the
people,
yeah,
educate people.
right,
Oh
right.
no.
Yeah, so the debate at the federal level is not over whether the government can create money. It's over who it should create money for.
Oh, that
Yeah.
is, thank you. That is perfect. And I'm going to go into this next discussion because you said you talked about the housing market a
Hmm.
little bit a few minutes ago, and you talked about um, housing stock and that kind of thing, and that this is very important. And this is very, I love how this all comes together because there is a story here that the Washington Post published, and let me bring it up. They did a study of 40, let me expand this so you can see. They did a
Hmm.
study of 40 major metro areas,
Hmm.
and they found that the share of homes bought by investors increased from the start of the pandemic to the first quarter of 2021 by 15%. And that may
Hmm.
not sound like a lot, right, y'all? That they're
Hmm.
like 15%, no big deal. But when we look at each of the 50 or 40 major metro areas, and we're not going to look at all 40 tonight, obviously, but I'm going to give you a link to this article. We see that the metro areas that are the most impacted, that have the
Hmm.
highest concentration of investors purchasing homes in these areas, are mostly Black neighborhoods,
Hmm.
disproportionately affected.
Yeah.
What does this mean? They say it, right at the top. Investors bought nearly 1 in 7 homes sold in the top metropolitan areas. One
Hmm.
in seven, the
Hmm.
most in at least 2 decades.
Hmm.
15% of all homes sold in the 40 markets. And I was just looking at this. So what this looks like in a place like Washington D.C., which is
Hmm.
already highly gentrified.
Hmm.
Uh, and let me see if I can get this in here for you. So if you look at Washington D.C. in the triangle kind of thing here, these areas are already gentrified. There's not a lot of housing stock that's existing left for investors to buy.
Hmm.
But here in the part of Northeast DC and a part of Southeast DC, 33%
Hmm.
of the homes purchased in these areas were bought by investors.
Hmm.
23% here in Southeast, 20% closer to Maryland, but also in Southeast. Why is this significant? These are the areas in Washington, D.C. that have the majority Black and majority poor populations.
Hmm.
And so if you go through this article, you'll see this pattern play out in every major city that they highlight. They point out in this article that neighborhoods where a majority of residents are Black have been heavily targeted.
Hmm.
30% last year of home sales in majority Black neighborhoods were to investors,
Hmm.
compared with just 12% in other zip codes. And I want to skip down to this quote um, from this person at Redfin,
Hmm.
which is the real estate company. said that the shortage, they believe that there is a shortage of housing. That's what they're chalking this up to. The shortage comes from too few homes being built. um, there's a profit to be made. If we were building enough housing, there wouldn't be as much investing activity in the housing we have. If we had enough homes to meet this demand, everyone would be able to buy a home. But Dr. Tauheed, I don't think that's true at all.
Well, this in the 2008 financial crisis, it's been dubbed the Great Recession. That was a financial crisis that was mostly driven by what was going on in the housing markets, right? Now, the cause of that housing crisis was blamed on subprime borrowers, the persons who didn't have great credit, so they had to pay higher interest. But the real cause of the crisis was fraud by mortgage brokers and mortgage companies, and the fraud that went on in what are called mortgage-backed securities. Someone just commented that the best way to rob a bank is to own one, which is the name of a book by one of my colleagues here at UMKC named Dr. William Black. He's an expert on that kind of fraud, and he wrote the book on it. And so in 2008, the housing crisis meant that there was a lot of foreclosures that came as a result of that, because many people were found that the value of their housing, of their homes, plummeted, so that the value before the bubble broke was much higher than the value afterwards, because you had lots of housing that was out there. That's what happened. That's an indication of I say, not too many houses, but houses, the prices of housing being artificially bid up by people who are buying houses, investors, and flipping, and so forth and so on. And so housing prices are going up. When that bubble broke, we ended up with lots of foreclosures. Those foreclosures were mostly in Black and high percentage, the greater percentage in Black and brown communities, because we did have an economic recession, and people lost their jobs and couldn't pay their mortgages and other kinds of things. And so we had foreclosures, and institutional investors came in to buy up those houses. Now think about this. If you are buying a house and you lose your job and you can't pay the mortgage and you're foreclosed on, you still have to have somewhere to live.
Hmm.
So what do? You rent the house next door that was foreclosed on a couple of months? So these houses are still going to have people living in them, but instead of the people living in them owning the house and building up equity and wealth in that house, all of that wealth is gone
Right.
because they've been
Right.
foreclosed on. But they have to live somewhere, and when they manage to get a job back and so forth, they are now renting a house that's owned by an institutional investor. So the institutional investors flooded in to buy the houses that were being foreclosed, and the same thing is happening now with people who through the pandemic were ready to be foreclosed or,
Mm.
or or on, but the foreclosure moratorium prevented that. Now in 2001, we're getting persons who are being in 2001, the end of 2001, foreclosures are up, and institutional investors are coming in to buy those houses, and they're going to rent those houses back to the people who lost those houses,
Oh my
right?
God.
And so the idea that is that there's not enough housing. There certainly was a house building slowdown during the pandemic, and the price of housing went up. It escalated during that period of time. Inflation, that part of that is what drove inflation rates. Right?
Hmm.
But institutional investors are simply taking advantage of the situation in buying houses that people are being foreclosed on. I mean, it's not like persons who own their houses are being offered a lot more than their houses are worth and decide to sell them to institutional investors. Those houses are being foreclosed on. So there's a supply of housing that people are not able to buy or pay their mortgages on, and institutional investors are buying those houses up, and they will rent those houses, and rental rates are going up. And so people are ending up renting houses that they used to buy, and their rent is higher than their mortgage was before.
Mm. Mm-hmm.
But they've got to live somewhere, and so they're enduring that pain.
I mean, if that were not repulsive enough, the fact that the real estate industry is blaming this on a lack or a shortage of stock.
Mhm.
Leah asks another great question: how, if at all, are individual real estate agents contributing to the impending bubble burst? Because it
Mhm.
sounds to me like, Dr. Tauheed, like we are looking at another bubble burst
Yeah,
in
we are. I
housing.
think we are in another situation of housing prices going up. Look, there are a couple of things that drove housing price increases during the pandemic. One of which is people who were able to work at home. If you're living in a city and you're in an apartment and commuting back and forth to work, pandemic comes along, you're able to work from home. Many people decided that that was a time to buy a house. Now they may have moved out of the city out into a suburban or rural area to buy a house because the internet goes out there too. And so you had those who were taking advantage of that situation of being able to work from home to buy houses. That increased the value, the price of housing, right? Because the demand for housing went up temporarily. And so in that situation, you got a bubble that's formed in the price of housing that is going to subside when when the companies that want their workers to come back to work want them to come back to work, and they can't work. And so there were stories, for example, of people who were buying houses a long ways away from where they have to now go and commute to get back to work. But there are also stories of people who are of companies that are realizing that my employees, even though they're remote, are as productive as they were before, and why should we pay for office space and other and
Mm.
utilities at the office and so forth? So it actually reduced the cost of business to have their employees pay the light bill and the electric bill for the computers and all that, and pay for the space while they're paying for their mortgages instead of the company. So there are a lot of companies that are adapting to this and going more and more remote. So you have an office space glut. There's in major cities, many office buildings are nearly unoccupied.
Hmm.
If I remember the question, it was how are real estate agents involved in this? Well, real
Sure.
estate agents are always, part of the selling of real estate is to talk about how much the real estate values have gone up. You buy a house now and look at this house, the history of this house last year, its value has gone up 25%. And we can expect that to continue to go up. And so buy this house now before it gets, too expensive later. And so real estate agents they churn the market to try to get people to buy now. But of course, when people buy now, they don't buy later. And so there's no demand later,
Hmm.
and the bubble starts to come down. I don't think that the collapse of this bubble will be as great as the collapse in 2008, because that was a housing crisis in
Right.
finance, housing finance crisis. This is a different. This is not a housing finance crisis, and we'll see homes being built again. Part of the reason for the slowdown in home building was increase in lumber costs. I mean, lumber prices went through the roof, and builders were not able to build the houses at the costs or the prices that they want them, and so they simply stopped building for a while.
I mean, this reminds me of, we have a comrade who lives in Philadelphia and who just won her a case against one of these investor kind of uh, uh, home purchasers, but it was a family of folks, and they literally tried to physically threaten her. They locked her in her room, tried to claim that she didn't have a right to use the entire house, violated a 30-day move out notice. And while that is like the face of gentrification, people look at gentrification as some type of, very typical economic churn, right? Where people who
Mhm.
are more, better off don't want to live far away from metropolitan areas anymore. Like it's like the reverse white flight, right?
Mhm.
Like
Mhm.
middle class and wealthy white folks moved out of the cities after, the great migration, because blacks from the south moved to the cities because that's where the industrial jobs were. And now all of those folks' families don't want to live far out in the suburbs and the exurbs. They want to move back into the cities. Cities are becoming cosmopolitan. Banks and investors and businesses are throwing lots of money into urban revitalization. So now
Mhm.
cities are becoming attractive. The working class and poor Black and Latinx folks who lived in those cities can now not afford to live there anymore
Yeah.
because of this infusion of cash. And then
Mhm.
the wealthier people come back from the suburbs, and people
Mhm.
think this is just like a natural kind of economic cycle, right? It
Mhm.
like the changing of seasons. It's natural, and there's no harm done. But there's a lot
Mhm.
of harm done to
Mhm.
working class and poor people in a and it's criminal, Dr. Tauheed, in a country where there is literally enough housing for every homeless person, that we
Mhm.
don't have to have a homeless problem
Mhm.
because
Mhm.
there is enough housing to house everyone. But then
Right.
there's this thing called capitalism.
Mhm. And
That, yeah, go ahead.
well, cities play a part in this process. Even though if you were to ask city managers and so forth what part they play in gentrification, they would say it's just a natural process, as you say, it's just happening. But what cities need and well what they strive to get is taxpayers, right? And so if
Mm-hmm.
you're in an area of the city where homes have been depressed for various reasons like redlining and lack of insurance and other kinds of things, then you're in the part of the city where property taxes are low. Now, in those parts of the city, what many cities try to do to get revenue out of those residents is code violations. They're very intense on making sure that you don't have a chip of paint falling off the back of your
Right.
houses, and so you get fines that way. But that becomes very very oppressive. And so what cities want to do, and I say this and understand what I'm saying, they want to replace the current residents with a better class of people.
Mm-hmm.
People are
Oh,
going to
we
pay more.
get that.
You got right.
Mm-hmm.
And
Yeah.
so they are going to go into an area, declare it blighted, declare eminent domain, hand it over to a developer who will take two lots where houses are worth $50,000 on each lot, and that's not a Washington D.C. situation. That's a more Midwest situation.
Right.
Right. And combine those lots together and bring someone in who can pay $500,000 for the house. Well,
Mm-hmm.
and so that now your property taxes went up from 100,000 assessed value assessment to assessment on a 50,000 50 $500,000 house, and so property taxes go up, right, and revenue to the city goes up. And there's a logic in city planning and development in these parts of city government that drives that wanting to do that, to have more revenue for the city, right? And so folks who are displaced in that process, they have to go somewhere,
Mm.
right? But cities don't care as long as you go somewhere outside of the city, you know. And there's a great process of cities when they gentrify a neighborhoods, then those folks will move out into the suburbs, where the persons who are moving out from the suburbs are moving into the cities. So you have this cycle of churning, and it's kind of in real estate. There's a kind of a 30-year cycle,
Mm.
because mortgages are typically 30 years.
Right, right.
And after, if you have a home and you've paid your mortgage after 30 years, the mortgage company gets no more revenue from you. So they have to figure out, how do we get revenue? So they will have a process of trying to move people from the inner city out to the suburbs, and people
Mm-hmm.
from the suburbs back in the inner city. That creates two new mortgages, and so the process it continues on. There's this logic of cities and logic of real estate that works hand in hand to make sure that some neighborhoods become blighted, are not well taken care of, and then the city is ready to invest in new
Right,
persons coming in, but they won't invest in the old residents.
right. Now, because we started this conversation with the Federal Reserve, I think it's a good time at the end of the conversation to ask, what should we be expecting from the Federal Reserve in these to address any of this?
Yeah. Yeah, I think the Federal Reserve is definitely going to increase interest rates. It says 25 basis points, and what a basis point is, one hundredth of a percent.
Ah,
So 25 basis point is 25 point is a quarter of a 0.25%, or quarter of a percent. There are those who wanted to go even stronger and make a half point increase. Well, I don't think they'll go do a half point. They'll do a quarter point, and then they'll do another quarter point and another quarter point. So by the end of this year, interest rates could go up by as much as 2%. And if it goes up, and you start to have a slowdown of the economy, particularly as people, for example, there are those who had child tax credit that was coming in
right,
because of the bill. Well, that ended in
right.
December.
That
And,
ended.
and,
That ended.
and so, you had half of the children who were in poverty being lifted out of poverty.
Mm-hmm.
Now those children go back into poverty,
Right,
right? you
right.
know, and so we will have those kind of effects. And when the Federal Reserve increases interest rates, if it's too much, um, it will certainly slow down inflation, but it will also cause higher unemployment. The unemployment rate in the African American community has been for a while twice what it is in the white community. It's but
Mm-hmm.
4% overall, which means
Right.
it's lower for whites, and it's 9% for African Americans, so it's more than twice. And that rate will go up in the African American and Latinx communities, and you'll have that tale of two cities. Some parts of the economy will do well, and some parts will not do well.
Well, Dr. Tauheed, thank you so much for joining us again and explaining all things economics, Black economically speaking, because this stuff is absolutely important to our survival. Don't be afraid of the strange economic and financial terms.
Yeah.
That's why we do this show, to make it all clear so we can have a clear path forward. So thank you for joining me tonight,
It's
Dr.
been a pleasure.
Tauheed. We appreciate you, and y'all stay tuned for what it is, Dr. Jared Ball and Dr. Greg Carr having a conversation about, does voting really matter? Thanks so much for joining us tonight in Lukman Nation. We will see you next week. As always, y'all take really, really good care of yourselves and each other, and peace if you are willing to fight for it. And they are out here throwing up the peace sign like they won something. Yep. I don't understand what they think they want.
I need to revise. I did see white people this happy. I gave the example of America and the Allied defeat over Nazi Germany. But I haven't seen this many white people happy. There was a couple periods in history. One was when Nutella was introduced. And I mean, I haven't seen that many white people happy since Nutella was introduced and marketed and stuff. Because white people love Nutella.
They booked the surgery just to pull me out of the basement. Right back where I started, nothing to show for a facelift. Got pushed playing Walter White and Davis, never felt so dangerous. The type of power they can't quantify. And name the best from my region, you gotta utter mine. Think of who really putting on, you never come to mind. Rapping like your Spotify, tap you rappers compromise. Yeah, no need to panic, just paint the canvas. If you can feel the static, you're too close, find your balance. Embed the revolution for their prohibition bandwidth. Blood trickle from the leaders he was planning. I had them all line before I dial up. How they claiming they on top when I'm a mile up. I had them all line before I dial up. How they claiming they on top when I'm a mile up. Boy, that flight to Amsterdam. Well, my accountant of mine, that's my family, found out too and didn't like it. You're not in the salon with Dale said, and I thought he was biased. Then I got a Venmo that said copy the finest. Before my foolishness settled in, recorded a whole tape before we got to Berlin. This close to giving up and now never again. Don't overlook the work and come expecting to win. In the end, my word, never put nothing over the squad. Got it right up under their nose, gentrify the facade. Off the cliff with broken wings, I'm aware of the odds. Enough faith for us all, I'm the one for the job. Most days, catching sun rays, baby, look like the front page. Overthinking what they might say, have it your way. Yeah, the biggest threat is something they never seen. Dial it up, patch me into the screen. I had them all line before I dial up. How they claiming they on top and I'm a mile up. I had them all line before I dial up. How they claiming they on top and I'm a mile up.